Okay, so if you just go back to the three chapters which we completed in this section, first thing was to explain to you what is jurisdictional blending. Second thing was, how SBIE is computed and how excess profits would be computed. So that's 5.2. 5.1 was like, the jurisdiction blending and the mechanics. 5.3 was an additional, just to kind of see how the computations, what are the step by step which we could do. And one of the steps in yesterday's computation was QDMTT. So let's understand what is QDMTT so that all the clouds and doubts based on that would be erased. We'll also be checking at QDMTT safe harbors is applicable. So what is QDMTT in the lens of the whole setup, the whole globe setup? That is, why would this be considered as an eligible deduction and what we should know about QDMTT? This is the whole summary of today's chapter. So there would be a little technical things, but stay with me and ask doubts if you have any. If you have any doubts, please ask questions. I would be more than happy to explain it again. Okay. So with that background, let's start. So after completing this chapter, you will be able to identify jurisdictions with a qualified domestic top-up tax. Okay, which are the jurisdictions which have a QDMTT? Understand the QDMTT priority rule, apply the QDMTT safe harbor, and determine when QDMTT eliminates IAR and UTPR liability. So we will discuss the entirety about QDMTT, not the computation part, but rather like once you compute, how do you apply that? So that would be what would be discussed. Okay, are you with me? Can you give me a thumbs up? Thank you. Keep that rolling. Okay. Now, why would anybody have a QDMTT? You tell me. Why is QDMTT a part of this globe computation? Hmm? So if we kind of, just kind of take, yes. So let's say that, the mechanism of this, okay. The mechanism is like this, like, if you compute top up taxes, if you compute top up taxes, okay, of the jurisdiction, first would be QDMTT. Then, if there is anything remaining, then it would be IAR, and then if anything is remaining, it would be done by it would be subjected to it will be subjected to it will be subjected to what? Can I get an answer before we go to? It would be UTPI. Okay. Okay. So then you are with me. Fine. So you tell me why. So who collects this? Who collects this? Let's understand who collects this. This would be collected by the jurisdiction, right? Where the MNEs are located. And this would be collected by whom? This would be collected by the parent entity. I'm using a blanket parent entity because it could be UPE, it could be like IPE, it could be POPE, as the case may be. Yes, and UTPR is collected by the other constituent entities which have a qualified utility. Other CEs where the company has operations. So it's always the first charge is given to QDMTT because that is collected by the jurisdictional tax authority. Okay, it's if it is IAR, it's collected by the parent entity's jurisdiction. Say if you have a parent company in UK will get that 15% charge or will get that IAR, and UTPR would be segregated among the other jurisdictions where the CEs are. So since this top-up tax, jurisdictional top-up tax is generated from this jurisdiction, it makes sense that first charge should be given to the that jurisdiction because it's the source jurisdiction. Okay, so if I don't have a DMTT, what will happen? If a particular jurisdiction does not have a DMTT, then what will happen? What will happen is it will not get top-up taxes will still apply. It will not get anything. The parent entity jurisdiction will collect. So that's going to be a loss for you. Or let's say that it's a missed opportunity for you. So this workings or this mechanism is what made everybody like, okay, then we will also have a domestic minimum top-up taxes. We will also keep a domestic minimum top-up tax. Otherwise, the entities in my jurisdiction will pay taxes, but to others. So that's something that I can't, live with. So I will also have DMTT, but still there are like, a lot of countries which does not have a DMTT. Now, what makes a DMTT, QDMTT? We will understand all that. But is this mechanism, understandable? Like, why jurisdiction is applying, this. If without this mechanism, I would say we will not get a consensus from all the countries to implement such a tax regulation. Correct? My some tax that is invoking from my source, it is being collected by somebody else is something that people can't live with. So QDMTT is a very important provision by which we get global consensus to have pillar. Okay, so with that background, we will understand the theory. So the qualified minimum top-up tax represents one of the most significant strategic responses by source countries to the global frame. When OECD designed the charging mechanism with IAR applying before UTPR, it created an inherent tension. Jurisdictions that had deliberately maintained low effective tax rates, often to attract foreign investment, faced the prospect of seeing that undertaxed income picked up and taxed by parent jurisdiction or sister entities where elsewhere in the economy. So that's a problem. So just take UAE for example. We have been a tax, low tax or like a optimized tax framework for a long time. Now, just because you're operating in UAE, somebody else is collecting. That's going to be a problem. I understand that there are still something called CFC regimes, but this in the pillar 2 architecture, like this would be a problem for countries like UAE and all. So the QDMTT emerged as a mechanism to address this concern, allowing source jurisdictions to collect the top-up tax themselves before any foreign collecting jurisdiction could apply IAR or UTPR. Okay, so this is why QDMTT is there. Why we are reading this theory is this is what you have to reproduce for the exam. This chapter examines how QDMTT fundamentally alters the dynamics of global minimum tax compliance. Understanding QDMTT is essential not only for technical calculation purpose, but also for appreciating how jurisdictions are strategically positioning themselves with a pillar 2 landscape. The rapid adoption of QDMTT by investment hubs, low tax jurisdictions, and traditional tax competition venues demonstrate that. So, by investment hubs, low tax, so even UAE, everybody is adopting this. So, that demonstrate that group framework has catalyzed a significant shift in international tax policy, with source countries reclaiming taxing rights they might otherwise have ceded to resident jurisdictions. So, this is the importance of QDMTT, and these should be the language in which you should be writing. Okay. Okay, so what is QDMTT? A qualified domestic minimum top-up tax is a domestic tax that a jurisdiction imposes on its low-taxed entities to bring it up to 15% minimum rate before any IAR and UTPR can apply. This is something that you always know. Now, what is the core concept? Basically what we discussed now, without a QDMTT, low tax subsidiary, that is, let's say Singapore has a tax rate of 10%, and the remaining 5% would be collected by parent jurisdiction under IAR. Okay, but with the QDMTT, the low tax subsidiary, so let's say Ireland has 11.8%, source jurisdiction collects the remaining 4.2 or 3.2%. Okay, and parent jurisdiction will not collect anything because it's already covered by QDMTT. Right? So this is what QDMTT brings into the picture. It could take the source countries into confidence to come into and implement pillar. Okay. Now, Why do jurisdictions implement QDMTT? These are the, I know you already know the reason why, but to kind of like structure it in an answer. One thing is to preserve taxing rights. Absolutely. Okay. So I don't like this tax being taken by somebody else rather than I can take this tax by myself. So I could have a new income source now. Okay, so you can retain the top of tax revenue domestically rather than losing it to parent jurisdictions. It could simplify compliance. Okay, so you just need a single calculation under domestic law rather than multiple global calculations. So you can just calculate one time, like QDMTT and IIRs basically being the same calculations. You can just calculate one time and kind of like go through it. So you don't need to calculate the entire thing again when you are paying IIR. So, and protect incentives, like so let's say that there are a lot of incentives which are given by the by each country based on their dependency. So incentives are always a fraction of economics. So let's say that UAE does not have a resource. If somebody is planting something here for making such a resource, then you are giving some incentive. For example, UAE has a problem with water. So being in such a geographic location, okay, so if you are a desalination company, if you're setting it up, it is very vital that we need desalination plants to come up here. And if you're taking it as a private business, then we'll give you some incentives because it's much needed for the people. Same like India, like India does not have oil. So let's say that if you're making an oil refinery in India, I'll give you some. So it's all like those incentives can still be protected, and it is not that those companies would be subjected to Pillar Two. Whatever is the local incentives that would be protected, and also competitive positioning. So what happens is like I can demonstrate that I am country. I'm not a low tax jurisdiction, and I kind of seed and apply the global OECD policy. So that makes me very strong. Okay, there is no need for me to be blacklisted saying that I'm a tax haven. So at the same time, you can maintain investment attractiveness also. So this is why, why investment attractiveness is because if it's a safe haven, and governments, especially Europe, will say, okay, you are investing in a safe haven, then you pay that tax also. So that could come in. So if you have 15% minimum tax, that okay, you're just 15%, I don't have to pay 30 to 40% there. At the same time, there is infrastructure here, so it's kind of a competitive position. Optimized tax, at the same time all infrastructure as a thriving metropolis. So that competitive position can be preserved by country or places like Dubai. So strategic logic is straightforward. If the global minimum tax floor eliminates the competitive advantage of rates below 15%, jurisdiction can at least retain resulting revenue by collecting top-up tax themselves through QDMTT rather than ceding it to parent jurisdictions to INR. So these kind of questions come. Okay, why do jurisdictions implement QDMTT? Or they would say that thus you are an advisor to the government, and you have to advise whether QDMTT is needed. So you can't just say that it's preserving taxing rights. Okay, you have to gather all these points. So this is how you have to write. Okay, is it clear till now? Fine. So QDMTT priority role. You know that QDMTT gets priority before IAR and UTPR. So QDMTT applies first in the rule order. QDMTT by the source jurisdiction, IAR by the parent jurisdiction, UTPR by the sister. So only a backstop for uncontrolled top-up tax after all these two steps. Okay. So practical effect is, let's say QDMTT covers 100% of top-up taxes. So you have a QDMTT in UAE, which is imposing 15% tax. Then full liability is being covered by QDMTT. There won't be any payment that would be needed for IAR or UTPR. But if it, let's say, it covers 80% of the tax, okay, then that 20% would be taken by IAR and UTPR. If there is no QDMTT in the jurisdiction, the entire top-up tax would be allocated to IAR and UTPR. Okay, so this is how the priority rule comes. It's IAR and UTPR can be imposed only after QDMTT opts in. So QDMTT priority respects the principle that source jurisdictions have the primary taxing rights over the locally generating income, simplifies compliance by reducing number of collecting authorities, and eliminates the need for complex cross-border crediting mechanisms. Okay, so that is it. So basically, like we have been using the word QDMTT, QDMTT. What is this qualified? How can, let's say that all countries would have their own DMTT, right? Domestic minimum top-up taxes. How can it be elevated into a qualified status? You have to understand that no, if any country has a DMTT, that's not coming into the priority rule. It would come into the priority rule only if it has a QDMTT. Now, what makes somebody a QDMTT? What makes a top-up tax regulation of a country into a qualified status? You will understand. So for a domestic minimum tax to be qualified DMTT, it must meet three requirements. Okay, then only OECD will give you qualified status. Number one is functional equivalence. Now, basically, what it means is QDMTT must determine excess profits in a manner equivalent to the globe rules that we study. Okay, you can't kind of like bring in any other policies. You should the chapter 3 of I think globe income calculation should be same adjustments as article 3.1 to 3.5. These were separate chapters. That's how we designed this. Covered taxes should be same as articles 4.1 to 4.6. You can't amend that. You can't alter that. The same architecture should be followed. ETR calculation should be same formula as 5.1. SBIE calculation, same percentages as given by the Pillar 2 model, and excess profit determination, same as Article 5.2. So you can't change all these structure. You can't bring in new things and say that, okay, this should be there. Your DMTT should be composed of the same things. Okay. But minor variations are allowed. Now, where could I bring in minor variations? Minor variations could be applied. So let's say that, your DMTT says that it will apply to MNEs below 750 million threshold. That's okay. That's fine. Even if that is a variation from the original law, that's fine. So that's a voluntary extension. Or apply purely to domestic group. Right now, we only have two multinational groups, right? But if you want to apply to domestic groups also, your DMTT, that's also fine. Or let's say that instead of using the IFRS or like, the approved and the agreed accounting standards, we use the domestic accounting standards. If consistent outcomes are there, that's also fine. Okay, so these are the only permitted variations, but all the other mechanics and architecture of the pillar 2 framework should be intact. This is point number one. Clear? Now, second thing is you have to top up to minimum rate. Your top up tax should be 15% minimum rate, or like, you should top up to the 15% minimum rate. You can't say that, okay, you're imposing 9% corporate taxes. So my top up tax would be to a maximum of 9%. No, you can't say that. You have to definitely bring it up to 15% minimum rate. That's quite, you know, it's very obvious, right? Otherwise, you will not get qualifying criteria. Okay, so QDMTT should always be 15% minus domestic ETR into domestic excess profits as per 3 to chapters 3 to 5. Okay, so 15% rate, there is no negotiation on the 15% minimum criteria. You can't kind of lower the rate. Okay, so it's a 15% minimum rate. You can increase the rate, but you can't kind of like, lower the rate. Okay. Now, the key point is QDMTT may result in tax equal to or greater than that would arise under group rules. A QDMTT that systematically produces less tax will not qualify. Okay. So, so even if it, is greater than globe rule, say for example, 15%, you want to make it 25%, that's fine. That's up to you. They only ask for a 15% minimum rate. If you want to collect 25, go ahead. But but the thing is, QDMTT should not produce less tax. Third criteria is there should be consistent administration also. What does it mean? So QDMTT must be implemented and administered consistently with globe outcome. So what it says is that you can't give any related benefits. Okay, tax benefits that will offset the QDMTT. So, for example, let's say that if you're paying QDMTT, it could offset the corporate tax or VAT, or you'll get a refund credit. No, you can't kind of give any benefits for payment of QDMTT. Okay, just to attract investments. No, you can't do that. If you are doing that, then you'll be removed from the qualifying status. You will only be a DMTT. Okay, whatever you do in the DMTT, it's still IAR will apply. So there should not be any systematic shortfall. So what it basically means is there should not be, the DMTT rule should not have any design features that consistently reduce the QDMTT below the global. Okay, you can't kind of play through the rules and make sure that there are some planned shortfalls by which no, okay, we are keeping a 15% minimum rate, but if you apply the rules, you will always get it less than what you pay in the normal group. So you can't kind of like have such systematic shortfalls, and you can't use cherry picking. Now, what it means by cherry picking is, let's say that for this entity it will not apply. For certain entities they are giving exemptions. You can't do that if they are coming into the qualifying criteria or coming into the scope. Let's say more than 750 million euros consolidated turnover, then they should apply. You can't cherry pick and select over and above that. So that is what is meant by consistent administration. So three things which would kind of like make your DMTT, local DMTT, into QDMTT. And what are these? Number one is there should be functional equivalence. Okay, it should be functionally equivalent to the globe architecture. Second thing is there should be 15% minimum rate. Okay, you can't kind of like have a minimum rate which is less than 15%. Okay, for calculating top up taxes. And third one is there should be consistent administration also. Then only you will get a qualifying status. Now, who will come and see all this? There would be peer review. Okay, so once you set your rules, somebody from OECD, they say delegated team, would definitely come and check how your economy is, how your things are, and they will definitely see to it whether like you are having some systemic shortfalls or etc. So there would be peer review that would happen. After the peer review is what you will get a qualifying status. Okay, is that clear? So these criteria prevent this is your exam input. Okay, these criteria prevent jurisdictions from implementing superficial minimum taxes that appear compliant but systematically produce less revenue than group calculations. The related benefits prohibition addresses schemes when a jurisdiction imposes QDMTT but simultaneously offers refundable credits or grants that effectively return the tax. Okay, that's not fair. The functional equivalence measurement requirement, sorry, ensures the domestic calculation mirrors globe closely enough to genuinely satisfy the 15% floor. So it should closely mirror, but there are some permitted variations like domestic groups and less than 750 million or domestic accounting standard. That's all fine. Okay, but the main crux, the body of the things that we were discussing during the past 3 to 4 months, that should be consistent. Okay, so while you're doing the UAE QDMTT calculations, all that takeaway that you got from this and the exams you're writing, that's going to be squarely applicable there also. Okay, now, there is also something called QDMTT safe harbor. Now, what does it mean? Is that if you are a QDMTT, if you are a qualified QDMTT, then there is a permanent simplification mechanism introduced in July 23. Now, what it means is that when a jurisdiction has a QDMTT safe harbor. Now, first thing you have to understand is you should be a QDMTT. Okay, and OECD should also give you a safe harbor status. Then only it will apply. Just because you have a QDMTT does not mean you have a QDMTT safe harbor. You should be, in the central record of OECD. You should also have a QDMTT safe harbor status. Both should be there. Then only you will get safe harbor. No, what basically safe harbor is that? That should only when a jurisdiction has QDMTT safe harbor status, single calculation. MME only needs to calculate top-up tax under QDMTT. There is no need for an IAR or UTP. You don't need to do extra calculations in the parent entity saying that, okay, this is the jurisdictional top up tax minus this is the, you have to see calculations are all going to be same, but there is another return that has to be done at the IAR level, right? Yeah, top up taxes minus QDMTT. That need not be done if it has a QDMTT safe harbor and QDMTT return is filed. Then IAR and UTPR calculations need not be done. Okay, so only QDMTT is there. So deemed nil top up tax. So globe top up tax is deemed to be nil for that jurisdiction if you have a QDMTT safe harbor. Okay, so UTPR, and while applying UTPR and IAR, you can say that it's a deemed zero for that jurisdiction. Okay, if a jurisdiction, if one of your jurisdiction has safe harbor, QDMTT safe harbor, then it's already like proper tax is zero when it comes to IAR and UTPR. Now there should not no need of a duplicate computation, no need to run parallel globe calculations for parent sister entities and this. So it is a big relief. You only need to do QDMTT. Okay, if you have a QDMTT safe harbor status. Okay, now eligibility for safe harbor, it won't be given to everybody. First thing is you should have a qualified QDMTT. Okay, first thing is you should have a qualified QDMTT. Second thing is there should be inclusive framework recognition. So it should be listed on the OECD central record that you have a QDMTT safe harbor. Just because you have a qualified DMTT does not mean you also have a safe harbor. Okay, you should be separately listed as a QDMTT safe harbor in the OECD central record. And no related benefits, no tax incentives that reduce QDMTT effectiveness in your any other tax laws. And there is transitional or permanent status, either transitional qualified status or pure, that we will discuss. But this is what is QDMTT safe harbor. Moral of the story is you only need to kind of like do it once. You don't need to repeat the same for IAR and UTPR if that particular jurisdiction has a QDMTT safe harbor. IAR and UTPR top up tax would be deemed as zero. Okay, so this is the safe harbor that is given, and this is a permanent safe harbor. It's not that the safe harbors, normally safe harbors are for only a transitional period. Let's say small business relief, it's only for 24 to 26 first 3 years, right? But this particular one is for it's permanent, it's entirety. It's not just for the transitional or introductory phase, but it's going to apply for everything. Did you understand QDMTT safe harbor, what it means? Okay. Now, for QDMTT Safe Harbor, the July 23 administrative guidance specifies three specific standards. So what it says is, accounting standard should be equivalent. So for qualified DMTT, I told you domestic tax is a variation, but for getting a safe harbor status, you have to consistently follow the accounting standard also. Okay, so approved and accepted accounting standard should be. You can't have your domestic. If you have a domestic one, you will get qualified DMTT status, but you will not get QDMTT safe harbor status. Consistency standard, design features achieve globe equivalent outcomes. Okay, switch off rule applies. Peer review assess company. So what the switch off rule is? It should be consistently followed. So let's say that tomorrow, if it is not followed, if globe equivalent outcomes are not followed, if you're doing an amendment to your DMTT, then there is a switch off rule. They will switch off the safe harbor status. Okay, so that peer review will happen every time. And if an amendment is systematically reducing the intent by which we are giving a safe harbor, then we will switch it off. We will be applicable for IAR and UTPR. And administration standard. Jurisdiction means ongoing globe implementation framework monitoring requirements, and all three standards are met. Okay, so basically, like you will only get a QDMTT safe harbor if it is Control C and Control V of the globe model rules, including accounting standard. Okay, if you want to keep the rate more than 15%, you're welcome. If you want to keep the rate, or if you want to include domestic groups, you're welcome. If you want to include MNEs which is having a turnover consolidated or less than 750, that's welcome. But accounting standard should also be there for QDMTT safe harbor. Small variations, but it's more or less the same. That's what if I'm giving safe harbor, that means more or less 15% minimum top-up tax is collected by the jurisdiction itself. There won't be any trickle down into IIR and UTPR. That would be deemed as zero. Is this clear? Okay. Now, what are the benefits of safe harbor? This is for your exam. This is a direct question. Whether you are a consultant, consulting a country, whether safe harbor should be given. What are the benefits? Evaluate. They'll give the title evaluate means you have to both benefits as well as both pros and cons. So what are the benefits? Reduce the compliance burden. Absolutely. One calculation instead of two or three. Administrative simplicity, no reconciliation between QDMTT and group calculation because those won't apply at all. So you don't need to sit and do reconciliations and all the other administrative complexity. It's all fine. And certainty. See, basically, it's clear outcome based on domestic. Basically, when you make it domestic, the thing is, there is only one tax authority, and the arbitration and the assessment, everything becomes very certain in the sense like how it will go. If it goes multi jurisdictions, it is very difficult. So let's say that uh, you know, you are applying top up taxes, and you see, there are some IAR which is, but you have to now know how to handle the UK tax authority. So you have to pay consultants to pay. So it's a big problem, and there is no here since you're only meeting with one domestic tax authority, then there is good certainty. Sorry for the interruption. So, so you understand why there is QDMTT. So, what are the benefits of a safe harbor? Compliance burden is reduced. There is administrative simplicity, and there is certainty. Okay. So, Again, safe harbor represents a significant concession to practical compliance concerns. Okay, it's not a concession to tax, but it's a concession to compliance concerns. Without it, M&E groups would face the burden of maintaining two parallel calculation systems, one for QDMTT under domestic law and another for Globe under model rules, even when the outcomes should theoretically be identical, right? So when it's same, why do you need to maintain two, three? By deeming the globe top-up tax to be zero, where a qualified safe harbor applies, the inclusive framework eliminated redundant compliance work while maintaining the integrity of the minimum tax rate. For practitioners like you and I, the safe harbor creates a clear decision point. Once confirmed that a jurisdiction has a safe harbor status, they can rely entirely on the domestic QDMTT calculation without second guessing whether it matches a hypothetical global. So you can only do once. Okay, so QDMTT implementation status, it's there in OECD central record. Okay, the OECD maintains an updated list of jurisdictions with transitional qualified status for both QDMTT and IRR. And you can kind of like, let's take a look at the status. Yes. So it's just click away. So this is a central record. Okay. If you can just go and you will see that, so this is qualified IIR who has this. Okay. These are the countries which have a qualified IIR. Um, Yeah, you can see qualified IIR, qualified domestic minimum top-up tax, and QDMTT safe harbors. So, who has a qualified domestic minimum tax? And so, let's say, so these are the ones which has. So you can see that this particular thing they have mentioned the regulation, okay, or which is the DMTT regulation, and this is a QDMTT. Okay, all the mentions here are QDMTT, not just DMTT. They are mentioning what is their tax law and whether it is a QDMTT safe harbor also. Both should be same, then only it will go. Let's see the status of UAE if it is there. So yes, UAE is there. So UAE's cabinet decision 142 of 2024 is a QDMTT, not just a DMTT. It's a QDMTT, and it has qualified safe harbor status also. So that means, you only for UAE entities, you only need to do these calculations once. Okay, and it is applicable from 1st January 2024. So you can see these countries, and let's say that if and we don't have an IAR, so it's only going to be this QDMTT which is going to come, and we have a QDMTT safe. Is this clear? This is a central record. Okay, and you have to see when it is updated. It's updated only up to 1st December 25. So if there are countries which kind of like became QDMTT later, that won't be there. Okay, so you have to look at the updated list. Right. So this is a central record with the transitional qualified status. Okay. Now, what is a transitional qualified status? I told you there is a qualified status, right? But there is something called a transitional qualified status also. It's not qualified yet, but it is under transition. So what does it mean? Basically, if you see what is a if you see anything which also, it means during the initial implementation period, the inclusive framework allows transitional qualified status for jurisdictions that have enacted QDMTT legislation but not completed full peer review. So that QDMTT legislation came out, sorry, DMTT domestic legislation came out, but it's not really kind of like checked by peer review for to ascertain whether they have functional equivalence, 15% minimum rate, and administrative similarity. So that peer if you have a DMTT, and you self proclaim that okay, I am a qualified, but it's not reviewed yet, that's what is transitional status. Okay, you self proclaim, the country self proclaim, no, no, we have met everything, but it's under review, that's what is a transitional qualified status. So let's say transitional qualified means it is self certified. Okay, I kind of like self certified that I am fully qualified, but it's pending peer review. Okay, so till it is till the peer review is completed, and whether it is DMTT or QDMTT, it's called a transitional status. Okay, if you are fully qualified, peer review is completed, then it is okay. It's you are qualified, and there is something called conditional DMTT also, which we will learn. So, did you understand transitional DMTT or transitional status of your DMTT? Yes or no? Transitional means you have released a law. The country jurisdiction has tomorrow. India is releasing a law, okay, that I am doing top up taxes, but it is and India is saying that no, we have gone through, it's all control C control V of the globe model rules, we will even get a safe harbor. India is self reviewed it, self certifying that it is but it is undergoing peer review. Okay, so that is the transitional status. Now what is the conditional status? We'll understand. Did you understand transitional status? Yes or no? Okay, now there is elective QDMTT special rule. So what happens is some jurisdictions implemented elective DMTTs in 2024 where MNDs could choose whether to apply. Now what will happen is I'll tell you. So let's say that you are you are an MNE. Okay. So you are your UP is in UK, and let's take this MN. So and this is one branch, this is one branch, and let's say there is one entity in uh, Netherlands and one in Australia. Okay, and then you have three UAE entities. So there is UAE, and there are three entities in UAE. One a trading company, one a manufacturing company, or one a company. Okay, so this is the scenario. Now, you tell me, when is UAE implementing? When is UAE implementing DMTT? From 1st of January 2025. Correct? Only for years after 1st of January 2025 is when you will have a DMTT. But if you look at the central record and if you see Australia, which is my parent entity, which would kind of like Australia my parent entity for IAR purposes, it would be having an effective date of 1st January 2024 with respect to QDMTT, but my IAR is also charting from 1st January 2024, right? So my IAR is starting from 1st January 2024, and my DMTT or QDMTT as the case may be is starting from 1st January. So what will happen from 1st Jan to 31st December? Will there be any QDMTT? Will there be any DMTT? Right? But your IAR, your parent company's IAR starts from 1st January 2024. So that means for that year, hmm, for 2024, so calendar year 2024, there won't be no QDMTT offset, right? But there will be IAR applicability, correct? Yeah. So basically, since there is a difference in time frame between like both countries, what what some countries have done is they have given an method. So okay, our official DMTT is opening only from 1st January, but you can take an elective state. You can still subject CY 2024 to UAE QDMTT or UAE elective DMTT, and this elective DMTT will be offset with Australian IAR, Australian IAR liability, provided there are some conditions that is satisfied. Did you understand what is elective? So it is an elective, like there is no compulsion. DMTT law is coming only from 1st January. In 24, this UAE company and this group can elect whether to pay tax in UAE or pay tax in Australia. Okay, pay tax in UAE through the elective DMTT, or like ignore this and we'll do the QTMTT or we'll do the IA. You understand? This is elective DMTT. It's a short-lived thing when the introduction does not match. So if it is there, so the some jurisdiction implemented elective DMTTs in 24, where MNEs could choose whether to apply. These can qualify for transitional status if the DMTT becomes non-elective in subsequent years. So only if when would this be offset? When would this be offset? It would only be offset if two conditions are satisfied. DMTT becomes non-elective in subsequent years. So if you take the elective status now, next year anyways you have to pay DMTT. Okay, so DMTT becomes compulsory from the next year in the subsequent years, and MNEs cannot claim safe harbor if they elect. So if they elect out, if they say that no, I'm not going to take the elective status now, then even though UAE is having a qualified safe harbor status, you cannot take a safe harbor. You have to do for both. Okay. So this is the elective status. Okay. So here in this example, UAE would be UAE DMTT, UAE DMTT, which is elective for 2024. Like that election, basically, if you don't do that election, then not taken, then your safe harbor advantage for that MNE is lost. Okay. And it can be offset only if, like in subsequent years DMTT becomes compulsory. Did you understand what is an elective status? Okay, so here in this juncture in 24 CY, this group can take a call whether I will pay Australian IAR or I will pay electional UAE DMTT. Okay, if you choose not to take the electional DMTT, then you will lose your safe harbor completely. Well, and this would be approved electional DMTT only if in the subsequent years DMTT becomes mandatory. Here the subsequent years DMTT becomes mandatory. It's only for the transitional year that we are looking at the things. So did you understand what is an elective and transitional and qualified? Okay. So qualified is means you are in the central record. You're permanently there. Transitional means you have introduced a law and but it's getting peer reviewed. And election means you have a record, it's not getting peer reviewed also, but it's going or like you have a QDMTT approved for 1st January 25, but for 24 you can electively choose to put that, provided if you don't put that then you will not get a safe harbor. Once you file an Australian IAR, then you have to keep on filing Australian INR forever. You can't take the safe harbor status. Okay, so this is the option or this is the elective thing, right? So these can qualify for transition status if DMTT becomes non-elective in subsequent years and MNEs cannot claim safe harbor if they elect. Self-certification allows the system to function while OECD takes peer review. So you just, if you self-certify that you are qualified, that's fine. OECD takes peer review, but you should definitely become a QDMTT in the later years, and also your safe, you should mention that if you don't take this option, your safe harbor will be gone. If a jurisdiction status is later revoked, the MNE may face retrospective adjustments, making it prudent to monitor peer review progress and publish the concerns about specific jurisdictions QDMTT design. So another risk is, let's say that if this is in review stage, and if during the review they say that this is not a QDMTT, then you had paid the taxes. Now you have to retrospectively pay this also, double taxes. You understand? For 24. So that would also come. So you have to keep in mind, first thing is, if I don't take it now, I'll lose safe harbor, versus whether you will definitely get a QDMTT status in the subsequent years, whether it will successfully complete peer review. So that's a very vexing decision, right? You have to trust the the peer review process and what will happen there before doing that. Did you understand the election? Okay. So again, so that is the transitional, qualified, and elector. Now, what is QDMTT calculation mechanics? While applying QDMTT, source jurisdiction typically follows globe equivalent calculations. Okay, you should not. So, how you should calculate QDMTT is same as how you calculate top up taxes. Determine the domestic globe income using chapter 3. Determine domestic cover taxes using chapter 4. Calculate domestic ETR, calculate domestic SBIE, calculate QDMTT. Okay, same, ditto. Then only you will get a qualified status. So potential variations is domestic accounting standards, rounding differences. I told you there are like four, decimal places needed in the model rules. But if there are minor rounding differences, let's say that this law says two decimal, it's okay. Minor computational variations are fine, and local elections, different election choices than group wide. Okay, so what they're trying to say is there are a lot of elections in QDMTT. There are a lot of elections in calculating chapter 3 as well as chapter 4. You can take SBC election, you can take globe loss election, etc. So if there is any small local related election, that's not going to completely potentially make it a different one than this one. Okay. So keep any variation must result in QDM resulting to be equal to or greater than the globe top tax. If domestic calculation produce less, the jurisdiction loses qualified status. If domestic calculation produce less than the globe model rules, then you will lose the qualified status. You could lose the qualified status tomorrow also. Okay. So in that case, you have to now retrospectively pay IAR also. So it's a big problem for the countries as well. The permitted variations in QDMTT calculation mechanics reflect practical accommodations for jurisdictions that may use different accounting standards or make different election choices at the domestic level. However, the one-way tolerance prevents. So basically, this is the whole story. So yes, guys. So that's all about QDMTT. Now, as usual, we will do a small summary. Okay. So what did we learn today? What is if anything is not clear, you can kind of come, but summary is, so as a bird's eye view, what did we learn? What is QDMTT, right? Then we learned about why do jurisdictions implement QDMTT? Why do they do that? I told you four conditions are there. You remember? Competitive positioning, improved taxing rights, right? Local reliefs and concessions. So for all these, you have to go through that. So these are why they are implementing QDMTT. And then we learned about QDMTT priority rule. What is QDMTT priority rule? Is QDMTT before IIR and UTPR. Okay. Then we learned what is the qualifying criteria for QDMTT. Qualifying criteria is like, you have three conditions. One is functional equivalence, 15% minimum top up, and sorry, not 15% top up, 15% minimum rate, and administrative similarity. Okay, so it should be like, administrative similarity means like, you can't do cherry picking, you can't do any refunds or credit that would offset this, and also it should be similar to this. So these are the qualifying criteria. Like there are three criteria. Then we learned about what is QDMTT safe harbor. QDMTT safe harbor is only if you are listed on the central record, then only you will get. Now we learned about the eligibility criteria and also the benefits. What are the benefits if of QDMTT safe harbor? One is reduced compliance, right? You don't need to do two times, you just need to do one time. Then administrative simplicity. Okay. And third is certainty. You are only dealing with one tax authority instead of three, four tax authorities. So these are the kind of like, benefits for QDMTT safe harbor. Then we learned, about transitional qualified status. What is transitional qualified status? Transitional qualified status is basically you have self-certified you to be a qualified, but you are undergoing peer review. Okay, that also you can take it as offset. That's the whole thing. Even if you're transitional, you can take an offset. But the point is tomorrow, if your peer review is completed, and if it is not, then you would have to retrospectively pay IAR. And also we have election for the introductory elective QDMTT for the introductory years, which is basically this diagram here. Is this a good roundup of QDMTT? Is it fine, or you want to discuss anything else? Yeah. So we will close today, and tomorrow we will do de minimis calculations. Okay. Is this clear? QDMTT and QDMTT safe harbor and what it exactly is? Okay. Thank you, Ashi. Chalo, see you guys. So tomorrow then.